DRD Gold reported a 25% increase in second quarter headline earnings per share to 25 cents. This as gold revenue rose by 10% to 580 million rand. Craig Barnes, who's the CFO at DRD Gold, joins us now on the line to unpack these numbers for us a little bit more. Thanks so much, Craig, for joining us this morning. Well, as I said, headline earnings per share up 25%. We've seen production up 9% over the quarter period, and the company declaring an interim dividend of 14 cents a share, which is a little bit telling of prospects moving forward. But let's look back at the quarter that was. Run us through operations over the period and, just what kind of market environment you've been operating in.
Good morning, Alicia. Yes, thanks for the opportunity. It was a very pleasing quarter for us, the second quarter, which followed up on our first quarter very good results as well. Production was up 9%, as you said, and that is a clear indicator that our Crown Ergo pipeline and our new circuit, which linked up all our surface retreatment operations, is now stabilizing. You'll recall in the fourth quarter of 2012, we had a bit of a dip in our volumes and also grade, and that we seem to have resolved all those issues now. And our volumes have now stabilized at around about 6 million tons a quarter, and our grade is also looking pretty steady at 0.2 grams a ton. Obviously, in the last quarter, the last two quarters, we haven't had any interruptions in terms of labor issues, which has also assisted us in terms of producing a very good set of results.
Craig, the cash costs down 12%, which sounds pretty good in an environment where everyone is saying with electricity going up, labor costs going up, you say no labor problems. How did you manage to get those costs down by 12%, or was it an unusual high base that you were coming from?
I think that's largely driven by, obviously, the increase in production of 9%, and we've managed to keep our costs pretty stable over the last couple of quarters. Obviously, electricity price increases going forward, which will hit us probably in the last quarter of this year. Those are a bit of a concern, but we're comfortable if we can keep this rate of production that we'll manage to keep our cash costs at a fairly good level.
Craig, one also assumes that, as you've moved to ceasing deep-level mining, that in part plays a role in, in lowering those costs a little bit further. So take us through that and, the energy at the moment, that you're putting into investing in surface tailing retreatment specifically.
Yes. So in the surface retreatment type operation, very different from underground operation. Obviously, our labor force is a lot smaller. We have just over 700 permanent employees, which make up about 35% of our costs. Also, our electricity costs are a lot lower than what you would find in a typical underground operation, sitting at about 16% of our costs. So those above inflation increases in both electricity and also wages tend to have less of an impact on our operations. And going forward, obviously we've talked about investing 250 million rand in upgrading our plant to really drive efficiencies in terms of recoveries in the plant. That project is now coming to an end, that 250 million rand capital spend, and we'll see the commissioning of that plant towards halfway through February.
Craig, the 14-cent dividend per share, and we were talking about Sibanye, and one of the reasons that Neil Froneman said he thought it was a good place to invest was, and in fact the reason to invest was good dividends, an aging asset, not looking at a long-term share price where you can get your money back, but dividends. So how important is that to you?
Yes, we've been talking to the market about paying better dividends. Obviously, we've been spending quite a bit of capital on upgrading our plants, but we're now in a position with the performance that we're seeing coming out of the operations, we're in a position to pay better dividends. We're targeting around about a 4% dividend yield. That's what we've been talking to the market about. As you'll recall, that our dividend for the full year of 2012 was 10 cents. So the 14 cents interim dividend is a significant increase in our dividend. And I think you'll probably find that we now one of the largest dividend payers in the South African gold mining industry.
Of course, to maintain that, you've got to maintain production levels as well. What kind of production capacity are you looking at? And ultimately, at the end of the day, is it enough to leverage off the current gold price?
Yes, I mean, we've given guidance into the market that we are aiming for between 140 and 150,000 ounces of production per annum. We're happy in the surface retreatment type business that we can maintain a very steady production. We tend to have less interruptions than what you would find in underground operations. So with the model of being able to maintain steady production and volume, we are happy that we can continue to pay reasonable dividends.